Well, why don't we go ahead and get started? I want to thank everybody for coming to the webinar today. And we're fortunate enough to hear from Mike Lingle, founder of Rocket Pro Forma. Mike has presented here before and done an awesome job. He has a lot of experience in venture capital area and had some exits. And Mike is really good at taking something very complex and making it very simple to understand to where you actually feel comfortable doing it. Anyways, we're looking forward to, Mike, to your presentation. That's always good. And thank you for being here. And thanks for coming. And just a quick note, we're with the Innovative Product Development Center, and we're here to help companies develop products, raise investment, and get their products to market. So with that, Mike, thank you for coming and being here today.
Thanks so much. Thank you for the invitation. I've had a great time presenting here before, so I look forward to today's session as well. And I would just say during this session, I'm happy to keep it conversational. So if you have questions that come up, please feel free to either post them to the chat or just unmute yourself and ask the question, because we can all learn something from other people's questions. I have found in my life. Okay, so let me share my screen here. So today we're going to talk about financial projections and how to package them in a way where they tell the same story as the rest of your pitch deck when you're going out to present to investors. I am a presentation guy. I'm a serial entrepreneur. Most of my startups were in the presentation space. So I do a lot of thinking about pitch decks, sales decks, storytelling, narratives, how to present information in a way that is easy to understand, but also carries people along. I've done a ton of work with startups. I guess in the last 10 years, one of my companies got acquired about 10 years ago. And since then, I've pretty much exclusively worked with entrepreneurs. So I've run a few different accelerator programs, done all kinds of mentoring, consulting, coaching. And what's happened over the past few years is I keep seeing entrepreneurs trip over their financials. Entrepreneurs tend to be, and this is true of me too, I as an entrepreneur tend to be really good with the product and really good with the customers. But when I started my first business at 25, I definitely tripped over the numbers, which actually led to some problems. Like I had to lay off a good chunk of a really awesome team because I hadn't managed the finances properly. So I've become kind of obsessed with solving that problem, right? Like how can we help entrepreneurs very quickly not just create financial projections, but understand those financial projections so that they can run the business. And then when they're ready, go pitch investors. So that's what we're going to talk about today. And we're going to do three things. One, I'm going to give you my financial projection slide template, which is both a dashboard that is great for running a business and also exactly what investors want to see. I'll explain how it works. I'll explain how you tell the story with it. The second piece, when we go out to raise money, people always ask the question, what is my startup worth? So I will show you the 3-minute shortcut to get to that answer. And then last, I have a favorite slide for the last slide in a pitch deck, and I'll walk you through that layout and why I think it's the best slide. So at the end of this, you'll have some really good knowledge that you can use when you go out to pitch investors and raise money. I want to start this by saying that people prove me wrong all the time. So nothing I say here is meant to suggest that you can or cannot do something. The joy of entrepreneurship is that entrepreneurs are amazing and accomplish seemingly impossible things. I can just share my experience with you. The other thing I would say is you get what you negotiate. So, as we go through our startups, we're trying to gather as many resources as we can. That's really the goal of a founder. And so we're constantly negotiating with people to gather those resources. And you get what you negotiate. And you can probably negotiate more than you think you can. And we'll talk a little bit about that during this presentation. So I want to start with the financial projection slide. And the idea is to tell the story with both the numbers and the key metrics. And again, we can use this to run the business, and we can also use this to present to other people. So I'm going to flash my template up on the screen here. This is the template that I recommend. And most people, when they see this, have an immediate reaction that's something along these lines, where it just feels completely overwhelming, right? So what we're going to do in the next 10 minutes is take this and make it much easier to understand, and then walk through the story that it's telling us. So we're on overload when we look at that much information, right? We're seeing a lot of math. We're seeing a lot of little boxes. We're seeing time, because money is always in motion. We're seeing different types of costs, because accountants have their own language that they speak. And we're seeing cash accounting versus accrual accounting, which I will cover briefly in a second. So there are two big concepts that the accountants know that I didn't know when I started my own company. One of them is that there are three financial statements that work together. There is the income statement, also called the profit and loss, or P&L. There is the cash flow statement, and there is the balance sheet. And the income statement, and I'll explain this in a second, the income statement is on the accrual basis, the cash flow statement is on the cash basis, and the balance sheet is on the accrual basis. And so that's one concept. The second concept, and that's because accountants, right? We're drawing on thousands of years of accounting history. The second concept, and then we'll be done with the accounting lesson here, is cash accounting versus accrual accounting. So cash accounting works like my wallet. When I walk into a coffee store and buy a cup of coffee and pay with cash, I get the coffee shop gets the cash, instant transaction. We both have what we are eventually going to get, and we're done. When I walk into that same coffee store and pay with a credit card, that is an accrual transaction, and all accrual means is that there is a lag. So I walk out of the coffee store with the coffee, but I still have the cash in my wallet. What I've done is I've written an IOU actually to the credit card company, and the credit card company, I will settle up with the credit card company within the next 30 days, and the credit card company is going to pay the coffee shop out of their own pocket in the meantime, which is why they charge interest. So we're going to use both of these concepts in our business: cash accounting, instant transactions, and accrual accounting, transactions with a lag. And these show up in lots of places. Accounts receivable, so if we're selling to other businesses, those businesses make us wait. And the bigger the business, the longer they make us wait. So, if we're dealing with large companies, they may make us wait 60 or 90 days before they pay us. Accounts payable is the inverse, where we make people wait. And the way these transactions work on accounts receivable, so if I send an invoice to a large customer, on the accrual basis on my income statement, I book that revenue immediately. But on the cash basis, I may not get that cash for 60 days or 90 days. So my profit and loss statement, my income statement shows the revenue, but my bank account does not show the cash, right? Accounts payable is the inverse. When someone sends me a bill, I book that expense immediately, but I still have the cash, right? It's just like when I walked into the coffee shop and paid with a credit card. I now have, I'm showing the expense on the income statement, but I'm also holding the cash until I pay it. Deferred revenue, I'll talk about in a second, but this is a superpower of subscription business models. And it's when annual subscribers pay up front. So you get this giant chunk of cash up front, but we only recognize 1 month of the income every month for the year. I'll break that down in a second. There are other things, big equipment expenses, office build outs, security deposits, loan payments. There are lots of other things that differ between the income statement and the cash flow statement. And I do want to drill down on deferred revenue here, which again is a superpower of subscription business models. So it's when we come to a website and they say, $1,000 a month, and the fine print says when billed annually. So we only get this $1,000 a month price if we pay the year up front. So we have to pay $12,000 in a lump sum to get the $1,000 a month rate. And so when we prepay, the cash is received up front, so the business receives the full $12,000, but only 1 month at a time is recognized on the income statement. So we get the $12,000 in cash, we recognize $1,000, 1/12 of that, 1 month's worth of that on the income statement. And what that looks like, so in month 1, on the accrual basis, we show that $1,000 of income on our profit and loss or income statement. We create a liability called deferred revenue that sits on our balance sheet, and that lets us know that we eventually need to provide $11,000 more worth of service over the next 11 months, and we take in the $12,000 in cash right away. Month 2, we recognize another 1/12 of the income, which in this case is $1,000. We decrease our deferred revenue liability on the balance sheet by $1,000, and no cash changes hands. And then we just keep repeating this, showing $1,000 worth of income and reducing our deferred revenue liability every month for the remainder of the year until the renewal comes back up and we repeat the process. So this is super cash friendly for startups. And in fact, with subscription businesses, I actually sometimes suggest that they be a little careful with this because it can make it look like we need to raise less money, right? Because we're self-financing by pulling all this cash forward. So just make sure if you're going to have deferred revenue, these annual prepayments be a big part of your projections, that you can actually deliver, because it'll dramatically affect your calculation of how much money you need to raise. Also, if you can sell a 1-year subscription and that's cash friendly, why not also sell 2-year and 3-year subscriptions, right? So when I was putting together the website for Rocket Pro Forma, I did it in Wix, and then Wix says, hey, you got to pay us. And this is the page they flashed up on the screen, right? So they're pushing me towards that 3-year purchase because it pulls a bunch more cash into the business. And the difference to them in providing 1 year, 2 years, 3 years of service is minimal, but the cash impact is huge, right? And I just want to point out, I love looking at the user interfaces of companies that have spent a lot of time and money thinking about this stuff. Nowhere on this screen does it tell me what I'm going to pay. It only tells me what I'm going to save. Like it is a genius page. But definitely think about these 2-year and 3-year prepays if you have a 1-year prepay. And so cash and accrual are simply 2 tools in our tool chest. It's not that we're going to pick one or pick the other. It's that we're going to learn to use them both. And in any project, I need both a hammer and a screwdriver, right? So financial projections start with the income statement. Remember, the income statement is on the accrual basis. And then we'll talk about where the cash flow statement and the balance sheet fit in a minute. Financial projections start with the income statement because the income statement is what we pay our taxes with. This is what we submit to the government. This is our official statement on how much we earned and spent during a year. And the basic formula is revenue minus expenses gives you a profit and loss. This is one slice of what I showed you. I won't show you all the months to keep it simple. And then this is the income statement piece of that, right? So revenue is called revenue. And then we actually have 2 types of expenses. We have cost of goods sold and we have operating expenses. And this is accountant tradition. So we're going to follow what the accountants do. But basically the cost of goods sold allows us to calculate the gross profit and the gross margin. So when you hear companies talk about we have 54% margins, they're usually talking about the gross margin. And if we take the revenue and subtract the cost of goods sold, that gives us a gross profit, which is what we have to pay the operating expenses of the business. And the operating expenses are what we normally think of as rent, salaries, insurance, lawyers, whatever it is. In true startup fashion, we're spending more money than we have available, and we have a loss for the month, and that's why we're out raising money, right? But this is the income statement piece. A couple notes. To make it easier to understand, I typically divide everything by 1,000 so that there are less numbers on the screen. Again, I'm trying to reduce the information overload, and I remove all the decimals. So I'm not worried about the pennies, I'm just worried about the dollars. And so that 48 in revenue is actually 48,000. The EBITDA is a loss of $66,000, so this gets expensive pretty quickly. And then I'm going to add some other information. So, because the income statement doesn't actually give enough info to tell our story about this business. So the next piece, kind of the headline, is 1, 2, or 3 sometimes KPIs, key performance indicators. This is what's driving the revenue. So in this case, this is a transactions-based business. 972 transactions in month 8 delivers the $48,000 worth of revenue. The cost of goods sold specifically, and the operating expenses, probably at least a little, are tied into the number of transactions, right? So this could be for different types of businesses. It can be different things: number of sales, number of subscribers, number of active users, annual recurring revenue, monthly recurring revenue. There's a range of things you can put up here depending on your business model. But this helps tell the story both to me as an entrepreneur running the business and to investors who I present this information to. Then I talk about the headcount below the income statement. And with the headcount, I think it's always really interesting to tell the story of how many full-time employees we have, and I can show that development over time. And then I think the revenue per employee number is really interesting as well. Normally with a solid tech business, we're probably making between $200,000 and $500,000 worth of revenue per year per employee. And so certainly at the beginning, that number will be way off because we have low revenue and high headcount. But eventually, it should start to sort of fall into that $200,000 to $500,000 range. Companies like Apple do over $1 million in revenue per employee per year. But it's a good sanity checking mechanism, and it also helps target the right number of people at any given stage of the company. So people sometimes ask me, like, how do I project the number of people I need? And I say, divide your revenue by 500,000 and then hire that many people, more or less. All right, so the last piece at the bottom is a little bit of the cash flow statement. And remember, the income statement lies about cash, right? So for all these reasons: accounts receivable, accounts payable, deferred revenue, loan payments. But we lead with the income statement, and that's the core here. But then the next question is invariably, can I see the cash flow statement? So I got tired of dragging around 2 documents. So in my template, I just wire the cash flow into the bottom of the template. And so this shows the income statement, and it also shows the cash flow. And one of the mistakes I made as a young entrepreneur was I was using the income statement to drive as a navigational tool to run the business. And I wasn't using the cash flow statement, I was using my bank account, right? And I think what was missing, and that eventually led to some problems, and I realized I did not have enough of a cash buffer and we were way out over our skis. And the thing I didn't understand about the cash flow statement is the cash flow statement has the ability to predict the future of my bank account. And that is actually key for running the business and staying out of trouble, right? So I had a past metric of my bank account, but that is not the metric I needed in order to navigate successfully. So startups live or die on cash, right? This eventually led me to a place where I had to lay off a chunk of my team, which sucked, right? It sucked for me as an owner. It felt terrible. It sucked for the business because all of a sudden we lost a bunch of good people. And it was especially terrible for the team because they were relying on this, on this company to for their livelihoods, for their careers. We had made them promises, and we were unable to keep those promises because we weren't doing a good job managing the company, right? And I think with these cash flow statements, if you're going out to raise money, it's totally okay to have negative numbers here. In fact, that makes the investors feel needed. I have literally been in pitches to investors where there aren't negative numbers, and the investors say, well, this looks like you never need to raise money. Why are you here? Right? So the negative numbers make the investors feel needed. And if you want positive numbers, I would just put, the investment in financing, if this says $1 million, then, and this number is positive, I know that it's the $1 million from the investor that's making this number positive, right? So there's a lot of investor psychology in these pitches. Okay, so that is the information we need to rebuild the financial projections template and not have it seem so scary. So here we go. This is month 1 of the projections template. And you can see the income statement, the headcount, the cash. This is a little bit of a different business. So now we have 2 KPIs at the top. This is a subscription business. So we have the number of paid subscribers and we have the annual recurring revenue. And those are going to be our 2 key metrics. What I like to do is break out the first 3 months individually. And then I used to show all 12 months individually, but that leads to an even more overwhelming slide. So what I've started doing is condensing the first year into 3 months and then 3 quarters. So I'm able to cover 12 months worth of projections in 6 columns. Then showing a summary of that first year in year 1, and then showing year 2 and year 3 summaries. And what I will do, what I do when I'm putting this together, you know, in my world, and this is the financial projections template that I've put together. Basically, I go through and I answer questions about the business model, the projections over 3 years. So if I'm doing a subscription, I may have year 1 pricing, year 2 pricing, year 3 pricing for both monthly and annual. If there's any kind of setup fee. And then as I'm entering this information into the template is automatically creating the income statement for me. So I think this is what people think of when they think of financial projections. I never have to touch any of these boxes. These just get created for me. The cash flow statement, the balance sheet are all outputs of the model. And the pitch deck slide is an output of the model. And the pitch deck slide adjusts. So if I change my business model, these metrics will actually adjust for me. So if I were to go into the assumptions tab, and if I were to change this from a subscription business, so let's say I turn off the subscriptions and turn on the transaction business like we saw before, this slide, sorry, I think I have this forced. Yeah, this slide will update to say transactions. Or if I turn on the marketplace model, right? If I turn on the 2-sided marketplace, this slide will update. And now it's showing me the number of transactions on my marketplace, the number of sellers I have available in the market, the number of buyers I have available in the market. So I'll just wire this template into my spreadsheet and make this an output. So as I change the assumptions, this updates dynamically, and then I can just drop it into the pitch deck. All right, so now that we have any questions about any of that, I just covered a lot of accounting and presentation strategy.
So the 3 models you have are a subscription model, then a regular selling of products. What are the 3 models that you have now? Can you summarize those again?
Oh yeah, yes. So in here, and I think this covers most, but not all categories. So there's a virtual transactions model, which could be a marketplace, or it could just be, you know, consulting services or in-app purchases, right? But it's a virtual. There's a physical, and then we're going to get into inventory manufacturing. Maybe it's just in time manufacturing. Maybe it's batched, where I'm actually, you know, having a factory build something. And then there's subscription, right? And so at the top level, you can pick one or multiple of these, and I can actually string them together. So if I wanted to build like Amazon Prime, for example, I could just I would make subscriptions the primary. So that's the way Amazon Prime works. I pay the annual subscription fee, and then I buy things on Amazon. So as a Prime subscriber, I also do e-commerce transactions throughout the year. So I got tired of having to pick a different model depending on the business. especially because I work with so many different startups. So I just built something that lets me mix and match and customize and layer.
That's
And
pretty
then inside the,
impressive.
this has taken me a long time.
I can see, yeah.
And then inside the transactions business model, I actually created a two-sided marketplace model that I can just turn on or off with a checkbox. But if I turn it on, it lets me build a whole economy of buyers and sellers. I can take a percentage of transactions, charge flat fees, decide which side of the marketplace is driving the listings. I have a whole bunch of settings that I can. So there are some other models buried within here as well. And there's also like an ads and data revenue model. So yeah, this has taken me about 5 years part-time and the last year full-time to put together. But now it's pretty good. Like I can throw together a financial projection in like pretty much any financial projection in like an hour. Any other questions? Plus, I've learned a lot about, I've probably put together 1,000 financial models. So I just understand how a lot of different businesses work, which is fun for me.
When you're doing operating expenses, how detailed do you want?
You can do anything from like, sometimes people do a percentage of revenue. So you can actually, and that's kind of the simplest. I think it feels like the easiest, but it's the hardest for entrepreneurs, right? Because these numbers fluctuate wildly. And in fact, if we look at sales and marketing, research and development, and general admin as a percent of revenue in year one, this actually adds up to more than 100%, right? In true startup fashion. So I think these metrics work really well, are the simplest for an existing business, but the hardest for a startup. And then what I've done is create a series of questions. So there are a bunch of questions about employees, around expenses for employees. And then you have expenses for the 3 operating expense categories: sales and marketing, research and development, which is obviously a big one for tech startups, and then general administrative, which is rent, insurance, lawyers, credit card charges, also fulfillment. Like if you're doing any kind of physical, like if you're e-commerce and doing a Shopify or Amazon, that stuff is in G&A. But in my world, you're just answering questions about the 3 years, possibly with a growth rate, checking boxes, and you can start rough to get a general idea, and then over time, kind of dial it in. I would also add, it depends on what the use of this is. Like if it's for your planning, I think you ultimately want to get pretty detailed. If it's for investors, you need to make a call on how detailed you want to get. I think investors want to know that you've thought it through, but depending on the investor, they may or may not want to get down to the super detailed level. But I think the more you think this through, the better you will be able to operate the business, especially like once you go through this exercise, you have a mental map, right? And you understand kind of the levers you need to pull. And if things start going really well, you will know how to navigate. And if things go badly, you will know how to navigate. And that was one of the things I was missing as a 25-year-old hotshot developer trying to run a business, was I didn't really have the mental map until things went wrong and I was forced to learn the mental map really quickly. I heard someone say one time that we start businesses to solve problems for our former selves, and this has definitely been this project for me. Okay, so if we're going to drop this slide into our pitch.
One other question.
Yeah.
I saw you had some help or something built into this on the tab. You had a questions or help thing.
Oh yeah, I have recorded 1 million tiny videos and linked to articles.
How to, yeah.
Yeah, so any of these see hows will jump to like a little 2-minute video of me talking about whatever that particular concept is.
Oh, wow.
Yeah. I had this vision, like this dream that everyone will just be able to take this thing and it'll be so easy that people can just self-serve. So I've really been trying to do that. And in real life, I end up spending an hour with a bunch of different startups, which is fun for me and kind of good customer validation. It definitely makes the product better if I can see what questions people are asking.
Great, thanks.
Yep. Okay, so if we're going to use this as a dashboard and if we're going to pitch this to investors, let's think about the story it's telling. So I'm just going to focus on the dark blue sections here, which are the annual summaries. And what we're saying is we're going to get 1,100 subscribers in year 1, 5,000 subscribers, so we're going to 5x that in year 2, and then almost 3x it in year 3. So that's the story we're telling. Everything else on this slide follows from that. And now we can start to sanity check and come up with questions to try and figure out if this plan really can, if this is a plan that really supports that story. So first of all, in the revenue, I'm immediately looking for the revenue to follow kind of the same pattern, which it does, except we're 12xing the revenue and only 5xing the subscribers. So immediately my first question is, why is that? And then I start thinking, well, maybe there's a higher price, maybe we raised prices or launched a higher price subscription tier, right? But then whatever that is sort of evens out and we're kind of at the same 3x, almost 3x in subscribers and almost 3x in revenue from year 2 to year 3. So, I would ask a question about that. Now, when we look at cost of sales, there's a less big jump, right? We're only doing 4x, maybe a little less, and then maybe only doing a little over 2x. So I feel like we're probably underestimating our cost of sales or cost of goods sold here. And then I look at the gross margin, and now my suspicion is confirmed because even the best run virtual subscription businesses probably are only doing between 70 to 85% gross margins. So I think we're underestimating the gross margin here because these are just too high for a real functioning business. Similarly with the operating expenses, they are increasing, but not nearly at the rate of the number of subscribers and the amount of revenue. We're only 2xing and then not even 2xing. So there's something wrong here, right? We're undercounting both types of expenses, the cost of sales and the operating expenses. And so, I suspect we're undercounting the headcount. As I mentioned, probably with headcount, we're going to be in the $200,000 to $500,000 per employee per year range. And so we probably haven't hired enough people at least in year 3. Maybe we've hired too many in year 1. But if we hired more people, that would actually boost maybe our cost of sales if they were support people and maybe our operating expenses. But I think we're dramatically underestimating how much this business is going to cost, right? And then from a cash perspective, this probably is a little optimistic, and this may be a case where with the subscriptions, we're saying a bunch of these are going to be annual and pulling a bunch of cash forward, but it's hard to imagine that we could hire 16 people in year 1 on $300,000 worth of revenue and only need to cover, I can't see the months here in year 2, but only need to raise, $1 million to cover that, right? Like we're probably underestimating the expenses. So that's the kind of story that I'm able to see. And I can do that pretty quickly because I do 1 million of these. And investors who are good can do this same type of sanity check. Your challenge as an entrepreneur is this is the only one of these you're doing. So, I suggest running stuff by mentors. That's why you're in this program, right? Is you have resources you can tap into to try and sanity check your own projections before you go start showing them to other investors. And one of the problems I was trying to solve is it's really hard to learn how to do this and get in there and change little boxes. And so that creates kind of a binary. Either the entrepreneur is going to spend 3 weeks like lost in financial projections learning all this stuff, Or what they used to do was hire me to build their financial projections, and I would hand them this fancy model, but they wouldn't understand how to use it, right? So I was actually doing them a disservice. And so that's what led me to this kind of 3-year question and answer format, because it's much easier to answer these kinds of questions. Like, I'm going to increase everyone's salary 3% in year 2 and year 3, and then just let the model do all the work, right? And as an entrepreneur, if I go through and answer these questions and something needs to change, like, sorry, year 2, I can't afford salary increases, right? I can make that change. I don't have to go back to someone who built a financial projection. And I can also play around when I'm talking to an investor. Like, it's much easier for me to just drive my own ship. And then everything's updating automatically, right? The pitch deck slide, the income statement, the cash flow statement. It's just a much easier experience for me as an entrepreneur. I don't need to be a financial wizard, but I'm going to learn my business and I'm going to be able to make changes and update this thing as I need to. All right. Any questions about any of that?
Well, not a question, but I just a comment is I really like the way this looks. It does a great job of breaking things out into the areas that people will focus on, like what's happening, you know, near term, midterm,
right,
and long term, all in one page. I love it. Great job.
Thank you. I'm a presentation guy, so when I started diving into the numbers, everything for me is about presentation, right? So yeah, I sit around and think about how to make complicated things look easy. All right, so
I do have one question on the
yeah,
operating expenses. When you talked about the number of employees, do you ever get questions from investors asking about how many employees, what's your cost of operating expense, cost in employee salaries?
yeah. So and I have a
Notice
couple
it's
answers.
all bunched together and it's going to have insurance in there and all that other stuff. But employees is probably the biggest driving factor because it can change very quickly and it jumps in big chunks.
Correct. So I have actually built, this is the live version, not the presentation version. And you will see these little plus signs in the left column. So those allow me to break out the subcategories. And I've broken out the salaries separately from the expenses for each of the categories. And then this thing also spits out a use of funds chart. So you can see the use of funds here. You can set the target number of months. And then if you really want to get detailed, you can check this box and it will actually pull the salaries into their own category there. So you can do a drill down if you want on exactly what the salaries are. But I use this as a dashboard, and I use this in conversation with investors because you're absolutely correct. Like, this is a big brick, but we can start to get some detail here when we need it. Does that answer your question?
That answers it on
Okay.
one level. I'm still trying to think on how to, make a presentation. If you're somebody asks what's important, what isn't in terms of running a company. I mean, because you can have, I know Carl and I are involved in helping run a company, but we're not getting paid anything.
Right.
So I mean, it's kind of looking at, okay, when you start hiring people, how important is it, especially if you're research and development, your scientific staff is critical in terms of that, but your salary may not be. So
yeah, and unfortunately I had to create a little hidden section here that says number of reduced months at start, 6, and we're only going to pay 25% of the salary or 0% of the salary for those 6 months. I was sad I had to build that checkbox, but that tackles exactly the problem you're referencing, right? And as far as what information to present, I think people get very wrapped up in trying to present all of the information in the pitch deck. And I think that actually does a disservice. I think you want to present enough information in the pitch deck that it tells the story. But for anyone who's actually going to invest, you are going to have multiple conversations with them, including maybe a sit down with the financial projections where you do like a deep dive. And so I think the pitch deck is much more important to get the story right on the pitch deck, and then assume that you'll have 3 more or 4 more conversations with anyone who's going to invest where you can get in the weeds on the details, versus trying to cram all the information into the pitch deck and then it's just too much. And overwhelming. Okay. Are we done in 15 minutes? I'm just trying to do a little time management here.
You can go, feel comfortable with what you're doing. I mean, people have to go, they can go, but I think this is important to cover. You've got a great presentation here and it's good to get the big picture.
Excellent. All right, so I'm going to shift gears and I want to talk about valuation, because this is also something that drives me nuts as a founder. What is my startup worth? And so I just want to do a quick review on selling equity. And basically what that means is selling a piece of the company. So we're going to talk about 2 things here: pre-money valuation and post-money valuation. And so pre-money valuation is how much the startup is worth now before I raise any money. And that's the big question, right? How do we figure out what the pre-money valuation is? The post-money valuation falls into place once we have the pre-money valuation, because it's just the cash raised. It's just the pre-money valuation plus the cash raised gives us the post-money valuation. So we just need to find the pre-money value. So let's walk through an example. I'm raising $200,000. My startup is worth 1 million pre-money valuation. We'll start easy. What's the post-money valuation? You are welcome to use a calculator for this exercise. This one's the gimme. I need some prizes to motivate people. I got to figure that out. If you have any suggestions for motivational prizes, let me know.
It's just 1.2?
1.2 million, exactly. So we're literally just taking the pre-money valuation and adding the cash raised. So that's the math. Now, for the slightly difficult question, what percentage of that company will the investor own? Same example. $200,000.
200 of 1.2.
200 of 1.2, right? Exactly.
Yeah.
So the ownership is going to be 16.7%. And I think sometimes if you're raising money for the first time, be careful. Don't do the calculation off of the pre-money valuation, right? Because then someone would be expecting 20% of the company post-transaction. Always calculate off the post-money valuation. Okay. So here's how we're going to calculate the pre-money valuation in 3 minutes. And the idea is to get a good deal in the least amount of time. We don't have to get the best deal in the world. In fact, we may value the time more than the money. So I'm sure as startups, you've heard people talk about convertible notes or safes. Briefly, a convertible note is a loan. Instead of selling equity in the company, you're selling a future promise of equity in return for borrowing money now. And there's an interest rate. So we borrow the $200,000, we pay interest on it. And there's also a discount, which basically says, and there's a ticking clock. So the convertible note may have a 2-year ticking clock. And what we're saying is, we don't know what the price is right now, but within the next 2 years, we're going to raise money and we'll price the company during that round. And we will retroactively convert the loan with the interest at plus the discount. So maybe it's a 20% discount into equity at whatever price we decided, a year down the road. What a SAFE does is it takes away the ticking clock. So there's no forced event 2 years down the road. The SAFE can just sit there until the money is raised, or it can just sit there forever because the money's never raised. So the convertible note is investor friendly, is startup friendly. The SAFE is even more startup friendly. And I'm sure, the folks here can do a good job of navigating you through that. The reason convertible notes and SAFEs exist is that we don't want to tackle the question of what's the startup worth. We do start to get back into that question with the valuation cap. And briefly, a valuation cap protects the investor and therefore protects your relationship with the investor. So if I'm starting a company, you invest $200,000 in my startup, I hit a home run and create a company that's a $100 million company. Even with the interest on the $200,000 and the 20% discount, you're ending up with, let's say, $300,000 of a $100 million startup. So that kind of sucks because I used your $200,000 to hit a home run, but you don't really participate in the value creation. What a valuation cap does is it says, look, regardless of how successful I am, you will never convert to equity at more than a $5 million valuation or whatever the valuation cap is. So then you have $300,000 of $5 million, which is much more appealing to you. And then you are participating in the next 95 million of startup appreciation. So you kind of get back into the valuation discussion, even when you're trying to avoid it. So the back of the napkin sketch where we find the pre-money valuation is we're going to use the info we have. And so the info we have is how much cash we're going to raise. And we sort of know what percent ownership either the investor wants or we want the investor to end up with. So in our first round, we probably want the investor to end up between 20 and, well, I don't know, 15 and 30% of the company, right? So that gives us a ballpark. And we definitely know how much cash we want to raise. So we're going to use our actual example. So when we were raising money, we were raising a Series A and we wanted $2 million. And we went and pitched a bunch of people and we got a term sheet and we were talking to the investors and they said, we want a third of the company, right? So then we have the math now. We take the $2 million that we want to raise, we divide it by a third. That creates a $6 million post-money company. We're going to do some math again. What's the pre-money valuation of this business? Anyone? To get the pre-money, we're just going to subtract out the $2 million. So
Ian says 4 million.
That's the correct answer, 4 million. Oh, sorry, I'm not looking at the chat. I got to look at the chat. Nice work, Ian. Excellent. So 4 million. So that is in fact what the investors put in the term sheet. We hadn't really thought about the pre-money valuation. They came back and said, we'll do the deal. We'll give you the $2 million on a $4 million pre-money valuation. So we thought about that for a day or two. And then we went back and asked them for a $5 million pre-money valuation. So what percentage of the company do the investors own if it's a $5 million pre-money valuation? First of all, let's start at the beginning. What size company does that create? What is the post-money valuation of 5 million pre-money and 2 million in cash? 7 million. All right, Rhonda, awesome. What percentage of that company do the investors own? You can express it as a decimal or a fraction.
Rhonda says 2.3.
They will own 2/7 of the company. So they're going to own 2 million of the $7 million company, which is the $2 million of cash that they put into the $5 million pre-money valuation.
About 28.8, 28.6.
Correct. So with that one ask, we saved 5% of our equity, right? We turned it from a 33.3% deal into a 28.6% deal. And we just did it, right? Like we didn't spend that much time negotiating because we wanted the money. We did the deal. They invested the $2 million. There is nothing quite as awesome as getting $2 million in your bank account. It is also incredibly scary because now you have a responsibility to these people to do something amazing with that money. But I encourage you to use this formula to very quickly calculate the pre-money, because this gives you a back of the napkin sketch, right? And this is the only math that will work to deliver what both parties want. If you want this much money and you or the investor want to end up with this much ownership, this is the math, right? So your job is less about finding the value of your company and more about defending the value of your company now that you've found it. Okay. So once we have our back of the napkin sketch, and actually I will say, the way I like to put this together is you enter your plan and then the model just spits out a number, right? So we're going to burn through 250 grand in 12 months. The implication is in month 13, we turn cash flow positive. And that's based on the assumptions we put in here, which arguably are not 100% perfect, right? Like, so we build in a safety buffer, let's say 20%, to handle when things go wrong. And then we need to raise 300 grand, right? So we can use this back in the napkin calculation. Then if we plug the 300 grand in and say, for that 300 grand, we want the investor to own 20%. Okay, so now our post money, for that math to work, the post money has to be 1.5 million and the pre-money has to be 1.2 million. So now we know we're going to market at a $1.2 million valuation, raising $300,000. So now we just need to understand how to defend that 1.2 million. We did not have to do a discounted cash flow. We did not have to build a complicated spreadsheet, even though we have one. This is the math. All right, so now we need to find people who can help us sanity check. Because again, we have an information disadvantage where we have this one deal we're looking at, which is our deal, but the investors are looking at 100 deals a month, 1,000 deals a year. They have a very good sense of valuations, especially in their niche of startups. And so what we're looking for is the equivalent of a real estate agent, right? Like if I have a house and I want to sell the house, I can price the house myself, but I don't really have a good sense of the market, so I'm likely to price it in a way that doesn't make sense. Similar, like if I hire the real estate agent, they can come in and they can tell me, you know, if I'm crazy, but also if I want a certain price, they can tell me how to get there, right? Like how do you need to package this in order to get the price you want? And so the question is, who in the startup world can offer this type of perspective? Certainly the people in this program and the mentors they introduce you to. So I encourage you to talk to everyone. And also startup lawyers, right? Find yourself a real startup lawyer who does this all the time. Don't find yourself a lawyer who's going to help you with your startup. Find an actual startup lawyer. And if you don't have one, interview a few of them and run your valuation past them and get their feedback. But a good startup lawyer is seeing a ton of deals, right? And so they're going to have a pretty good sense of the pricing, and they can help you sanity check and help you understand how to package this in a way that gets you the valuation you're looking for. Also, obviously, pitch deck competitions, and then just road testing with people who aren't going to invest in you anyway, right? So finding mentors, finding direct people who will be kind of, it may feel mean, but you want to understand why they would never invest. And what happens over time, A, by doing your pitch over and over, you just get better and better and more comfortable with it. And then B, the pitch evolves over time, right? If you're pitching, the most important thing you can do is write down the questions you're asked. One pitch doesn't necessarily give you a pattern, but 2 pitches, 3 pitches, 4 pitches, if you're starting to hear the same question and the same pushback across multiple pitches, you probably need to deal with it, right? Which sometimes is changing text on a slide or changing a number on a financial projection, but sometimes you have to do a little bit of work, right? You have to go gather some data or change something, or there's some homework you have to do on the business. And what happens over time is you work your way up to your dream investors. And then by the time you hit the dream investors, you're firing on all 6 cylinders and you're super investable. And that's what happened to us when we were raising the $2 million. We probably pitched 40 investors, and the first 37 said no. And then the last 3 gave us term sheets, right? And it wasn't that we suddenly got lucky. It was that we were doing the work in the background, evolving the pitch, evolving the projections, evolving the company. And then we became investable through that process. So don't go pitch Mark Cuban first, pitch Mark Cuban after a couple weeks of pitching other people. A couple other things. One of the things I mentioned at the beginning, you obviously get what you negotiate. So, punch above your weight class in terms of negotiation and practice negotiating. But remember that time is usually more important than a few extra dollars. So when we did that negotiation about the pre-money valuation from 4 million to 5 million, we didn't spend that much time on it, right? We got 5% of our equity back, and then we just did the deal and got the money. We negotiated a few other things. I don't want to make it sound like that was the only thing we negotiated, but we just kept moving quickly because the money was more important than the terms. Also, when you're thinking about, when you put yourself in the investor's shoes, right? If I'm an investor and I have a fund, I have 1 million people asking me for money. I'm looking at 100 deals a month, 1,000 deals a year. They all start to sound the same. Even me doing financial projections, everyone's business starts to sound the same, right? So what makes people stand out, what makes deals stand out, is the hustle of the team, right? And so if we can be the kind of entrepreneurs who are always moving the ball down the field, every time we talk to the investor, we've done something new, we are going to stand out from that field of 1,000. Because the rest of the field is just waiting for the money before they do anything. But we're the team that's doing stuff without the money, and that makes us super interesting to the investors. And of course, once you have the momentum, you actually get your best deals when you don't need the money. I wish this for all of us, that we don't need the money and we can negotiate amazing deals. My favorite pitch deck story is, I forget the startup, but they had one slide in their pitch deck. It was just a hockey stick of revenue and profit growth. And the pitch was basically like, look, we're on fire. Do you want to invest? And of course, their deal was oversubscribed. Okay. One thing I would also say, we read in the headlines about these companies raising all this money, which is totally cool. You can raise a ton of money. Also, in some of the later stages, you can actually take some of that money off the table. So, if a company's raising 100 million bucks as a B round, a C round, sometimes the founders and maybe even the early investors are taking some millions off the table and putting it in their bank account, right? So, I encourage taking some money off the table when you can, but also keep your eye on the exit. So a little more math here. If we raise 5 million in cash on a $15 million pre-money valuation, and the investor wants a 10x or maybe even a 20x return, but let's say 10x, how much do we need to sell the company for to hit that investor's goals? I'm looking at the chat window.
200.
200, right? So we add the 5 in cash to the 15 money pre, that gives us 20 million, and we need to 10x it. So if we look at how much startups get acquired for, they typically get acquired for between 25 and 150 million. So we're already pricing ourselves at the extreme end of that. Not to say we can't get acquired for 200 million. It's just that there's a much smaller universe of acquirers the higher the exit price is. And at the extreme levels, what we see are these companies that have boxed themselves into a corner, and it leads to not being able to exit gracefully if things aren't working. We saw WeWork come to market with a $43 billion valuation. And within a few weeks, they were down to a $3 billion valuation, right? That's real money that's disappearing from the founders and the employees, right? And with Magic Leap, local Florida company, they raised $2.6 billion with a B to build a product that has never had a customer base, right? It's never worked as well as they thought it would. They've never been able to mass market it, but they raised so much money that there was no graceful exit, right? No one, like if they had raised 50 million bucks, someone could have acquired them for their technology. But because they raised 2.6 billion, there's no exit where someone can acquire them. And so they've had to just kind of self-destruct, and the founder's out and someone from Microsoft came in to fix it. We just saw the same thing with Quibi, right? They raised $1 billion and then no one could acquire them. So they just self-destructed, right? So just be aware. No one's saying you can't build a $200 million or $200 billion company. Just be aware of what you're doing to your exit, and what the options are that you are, the doors that you're opening and closing as you take on these rounds. All right, any questions on valuation? Hopefully the napkin sketch valuation will help you. All right, we're gonna do one more piece. This is short and fun. And this is what I recommend as the last slide of the pitch deck. And what we're gonna try to do is get the investors to write us checks, right? And this is the typical last slide, which I think is a real wasted opportunity. First of all, I'm sure the investors can find you if you're pitching them. Second of all, I think you're not really selling yourself with this format. So the layout that I really like is 2 columns. On the left column, I'm going to say what we've already accomplished. And on the right column, I'm going to talk about the raise and then what we're going to accomplish. And I think what this does, like I like to pop this up as the last slide and then leave it on. Oh yeah, and you can include your email address. I like to pop this up on the screen and leave it on while we do the Q&A and while we have the conversation about the investment. And it does a couple things. One, it frames the conversation. So this is what we're talking about, right? Here's what we've done without you. We're great. Here's what we're going to do with you. Here are the deal terms. Here's where we're going to get. It instills confidence because A, you're already hustling and you've already accomplished stuff without the money, and B, you have a plan. 3, it forces you to ask for the money. People, I see so many pitch decks where there's no ask, or people chicken out. Like, they say they want 2 million, but then they get into the meeting and say 1 million for whatever reason. So writing it down helps. I'll talk about this in a second, but it gives runway and targets. It talks about where the money will get you, which is different than talking about how we're going to spend the money. It also creates FOMO, right? We're hustlers, we're moving without you, we're doing this without your money, the door is closing, hop on board the train, right? And so breaking this down, on the left side, these are some things I would focus on. Now, maybe you don't have revenue, so maybe you need to talk about something else. Maybe you haven't raised any money or invested any money, but these are kind of a loose set of guidelines. So our launch status is we've launched the MVP, and then we have traction. We have 2,000 weekly actives, and then we have revenue, 3,000 a month in monthly recurring revenue, MRR. And the founders have invested 50K. All right, so as an investor, this gives me a great snapshot of where the business is at, how committed the founders are, and where we are in terms of traction. Then we can talk about the raise, right? So we're raising $500,000 for 9 months of runway. We're doing it as a convertible note. Oh, and here, half the round is already committed, right? So there's only half the round left. So this is the door is closing part. Obviously, you need to raise half the round before you can say this, but the more you can say the round is committed, the more the investors are going to jump, especially if your accomplishments look good. And then we're going to talk about where we're going to get with this money. And I think a lot of people use this opportunity to talk about how they're going to spend the money, which I think is interesting. Everyone knows you'll spend the money on product, people, and sales, right? So and I was showing you guys this use of funds. All of this is product, people, and sales, right? And no investor thinks you're going to have a hard time spending the money, and they kind of know what you're going to spend the money on. Is it useful to show the use of funds chart? Yes. Is it useful to have a conversation about maybe we should spend more on marketing? Yes. But I don't think that's what really gets the deal done. What gets the deal done is where are we going to be with this money, right? So if we look at 9 months, from the pitch deck slide, we can just pull in the metrics. So I can see how many subscribers we're going to have at the end of Q3, what the ARR is going to be, if I have a transactions business, what the revenue is going to be, and then I can pull that into my slide. And now this is where we're going, right? We're going to have 10,000 weekly actives. We're going to have 15,000 in monthly recurring revenue, and we're going to raise our Series A. So now as an investor, right, as an entrepreneur, this frames the conversation and really highlights both what I've been able to accomplish and that I thought this through. And as an investor, this tells me exactly what type of company I'm dealing with, what it's going to cost, and where it's going to get, right? So everyone has what they need in order to talk about the deal. And of course you can put your email address at the bottom. But I think this is just the last slide that I really recommend for the reasons I've stated. Any questions about this? Everything, all the slide templates that I showed you are just free. Just go to rocketproforma.com/resources. Email me with questions. I'm just mike@rocketproforma.com. If you do want to buy the model or a coaching session with me, there's a discount code specific for the IPDC. That's it.
All right, well, that is awesome. A really impressive tool system you built here. And so essentially, if someone, I guess, if someone's interested, they need to work with you to understand a little bit more how to use the tool, and you'll kind of coach them on that, and also look at their business as well.
Yes.
And provide advice on where they could go, or basically what type of, the value, where the valuation potentially could be, et cetera.
Correct. And I've worn a lot of hats. I'm like a jack of all trades. I've been everything from the software developer to the finance guy, to the operations guy, to the sales guy. So, I certainly have a lot of experience I can bring into a conversation. At the simplest level, people can just self-serve off of this, right? Like it's got, as we pointed out, there are a bunch of videos and stuff in here, and it's pretty straightforward. But I do also offer like hour or more coaching sessions, which could either be a setup, like let's go through and let's make sure this is set up exactly with what you want, or could be a follow-up, like, hey, I've done the work. Can you help me sanity check it, right? Can we go through the pitch deck slide and the assumptions and really make sure that this, the story I'm telling makes sense?
Okay, great. Yeah. Does anybody else have any other questions? Any questions?
Awesome.
Well, this is really great, and this will be recorded, so we will make sure that everybody knows about this as well. So, Mike, on the so we're going to send out an email at the end, letting everybody know, thank you, and then also what's coming up next. Is there anything that you would like to provide or give the folks that in the email that they would like to?
Sure. I think the main thing, just email me if you have questions. The resources page is here. And then there is, if you do want a spreadsheet template or a coaching session, there's a discount code.
Okay, fantastic. Right, this is great, Mike. I was really impressed. I mean, and you've improved it. Have you improved it since the last time?
Yes.
You presented this a while back? I mean, I don't remember all these new features that were there. Seems like you've done
Yeah.
a significant amount of improvement on it.
I have. It keeps growing. It's funny, like every session I do, I see what could make it easier. So it's kind of like getting paid for customer validation.
Yeah.
The only problem I have now is I've gotten so busy with the coaching sessions that I'm having to like block out chunks of time in my calendar to actually do the work on the product.
That's a high class problem, right?
It's a good problem.
Yeah. Well, Mike, thanks so much for this presentation. It's been great. Everyone also, thanks for attending. We'll let everybody else know and spread the word. And if there's anything else that you would like to offer or because we can put this out to all of our other IPDC startups that were not here.
Oh, great.
If there's
Okay.
anything else, just let us know. We'd be happy to share that with them in an announcement on our system.
Okay, perfect. I really appreciate that. Thank you.
So Mike, thanks again. Thanks everybody for attending, and we have a great week.